Like you're doing a disturb sign.
Hello, everyone.
Good
We're
morning.
back here, Concierge Lena. And we have as our guest Chris Verden,
Hello, hello.
Juan again.
Hello, everyone.
Our
And
fearless leader.
Yeah. The thing is, today we're going to be talking about FHA loans. We have been asked many times to give information on this type of concept. So we have Verden here. He's going to give us the best information that we have.
Awesome. So there's several types of loans, and one of them is the FHA loan. What's the main characteristic of an FHA loan?
You know what? FHA's been known for being the first-time homebuyer program. It's not to say that conventional loan programs don't offer something similar, but historically, this one has a 3.5% down payment. Most folks with conventional loans, even if it is their first home buy, has to put down 5%. The appetite that loan program has, you typically need above a 740 FICO to do 3% down. So with FHA, they say they'll do loans down to 500, but how many banks have an appetite to actually service and bank those loans? Not many. Today is March 2nd, 2022. We are starting to see the tail end of the pandemic. So we are seeing guidelines open up. Right now, we're doing loans down to a 580 FICO. That's with FHA, to be clear. So again, they're just well known for being a first-time homebuyer program because they do have lower down payment requirements, and they're also a little bit more risk adverse, so it's easier to get people in the door.
When you say appetite, what do you mean?
So again, FHA says that they will allow lending down to 500 FICO, but is Wells Fargo willing to service that loan and take the potential risk? Most people don't realize this. FHA is actually just a giant insurance company. The money is still backed and banked with institutions, but if somebody doesn't make their payment, they basically FHA will cover those mortgage payments. It's called PMI, private mortgage insurance. So you will find that FHA, again, will do the lower FICO loans because they are in the greater picture of things, they're an insurance company.
Okay. Yeah. Let's go deeper on that because a mortgage loan. So for example, like I said, I'm going to go really deep on this.
Yeah.
For example, what is your main job?
As a loan officer?
Yeah, let's break it down into pieces. Like, okay, so you're a loan officer,
Yeah.
There's a processor, there's an underwriter,
Sure.
And then the bank is you create the loan and then you sell it. And let's go from step by step.
Yep. So as an example, if you came to us and you wanted to buy a house, step one is we do a consultation for financing, right? So from there, we do things like get a 2-year history on employment, credit, income, take a look at your assets. All loan programs do allow gifts from family members. So if you don't have the cash, but have the means through family, that's a workaround. You can also use 401ks. Oftentimes, if you're relocating for work, your employer will give you a grant, basically free money for the purchase. So you've got a few options there. But so you do your consultation. If everything pans out, I took a look at your finances to make sure everything you told me in that meeting is true and lines up. If everything pans out, we give you the pre-qualification letter. It's a letter from our bank advising that we're backing you on the money, and those are good for up to 120 days. That's when the fun starts. That's when you get to work, you start seeing houses. Mr. Juan Grimaldo will put you on a subscription. You choose the parameters. Anything below your purchase price, we're here to back you up, right? Once we do get a purchase contract, me, the banker, my job is to follow the terms of the agreement between the buyer and seller. So this would be the price, the earnest money deposit, any unique structuring of that contract. And then I disclose the terms of the loan to you. This does involve the title quotes, the insurance quotes, and then that's when the 30-day ticker starts. Typically, we do see 30-day closes of escrow. From there, I submit the loan, and then I personally have a setup team. Not every bank operates this way, but for me to be available and to have the bandwidth for my realtors, I can't do every piece of the loan. It will absolutely kill me. Most people don't realize this. A loan takes literally 26 hands of touch, whether it's an appraiser, insurance broker, mortgage broker, funders, escrow officers, appraisers. I mean, it goes on. Realtors, buyers, the sellers. There's a lot of people involved in the loan.
Definitely.
So with that process being said, the setup folks do everything like verifications of employment, basically order appraisals, insurance quotes, things like that. Once the loan's prepped for an underwriter, that's the person for every bank who decides, yes, we want to lend, or hey, sometimes you get suspension where it's like, hey, we need to clear this up before we give you a positive review. And then, obviously the branding, not everyone works out, where sometimes you get the decline.
Right.
So the processor's job, once they get an approval, is to muscle that loan with all the conditions that the underwriter has. I would say 9 times out of 10, you don't just have a simple, yes, you're approved, here's your check. It's usually, hey, you know what? It didn't look like you worked for 3 months. What happened here, right? And to be clear, this doesn't mean you should be concerned or the loans decline. You may have honestly just been laid off because of COVID, and you didn't realize the guidelines give you up to 6 months of freedom of unemployment before you're deemed as possibly not qualifying. So the best practice is have a good conversation with your mortgage broker. Our job is to give you good terms, but as well as make sure you have a good lending experience. And bottom line is make sure that money's there on time, right?
Definitely.
So I guess once your loan's approved, you get the closing conditions. The bank is in a comfortable position to issue what's called a closing disclosure. At that point, they balance documents and fees with the escrow company to come up with my final numbers match your final numbers. Part of this has to do with the time of year when taxes are due. Part of it is even down to the calendar day. I'll give you an example. If you close a loan, let's just say on the 5th of March, you're not going to make an April 1st payment. You're too new of a client to be in a system. Your first payment would actually be May 1st. So to be clear, everything in banking, they do it for margin. They're not letting you live there for free.
Yep.
They're just going to hit you with what's called per diem interest. So maybe instead of bringing $7,000 to the closing table, you now got to bring $7,800 because you're bringing interest for 45 days, right? Same example. Let's just say you close at the very end of March, the 28th. Well, in that example, you're still not going to make the April 1st payment, but you're probably going to make the May 1st payment.
Yep.
So in that example, your cash to close might be only $7,200 instead of $7,800 because you're not covering such a far stretch of per diem interest. So these closing disclosures, they're very intuitive, they're very detailed. It's very important that that when you do it, you have that good conversation with your loan officer because that's pretty much the final preview of the loan terms. If there's any issues, hesitations, maybe they promise to pay for your appraisal and you see you're being billed, that's the time to speak up because once the deal's done, the cash is closed, you sign the terms, you sign your terms, right? So that's the job of the closers. They balance that with the escrow officers, the funders. There's one on the escrow side and the banking side. But at this point, you guys have kind of heard about the loan officer's job, the setup folks, the processors, the escrow funders on both sides of the fence. And again, the most important job of the loan officer is we deliver the terms we agreed. We make sure that all parties are satisfied with the final terms of financing and that check is on time for us to close on time.
Awesome.
Yes.
And the other thing that I wanted to kind of emphasize is, for example, we have the consumer who comes in to get a loan,
right.
Where Chris's job is to gather all the information that the lender needs in order for them to approve that loan.
Right, to the FHA guidelines.
Exactly, to the FHA guidelines.
Yeah.
And then once it closes, he produced that loan. That loan becomes a
mortgage-backed security.
Mortgage-backed security, which is then sold in the secondary market, which is when your 401ks, your IRAs, they sell these investment vehicles for other people. So I just wanted to kind of set that up because sometimes people say, okay, was he my bank?
Yeah.
Well, he was just
Sure, we could talk about that. So there's different levels of banking. There truly is, guys. Mortgage brokers, by definition, they are there to negotiate the best terms for you. There's good and bad. The good being that if you're looking for a refinance and you've got a little bit of time to spare, and again, if a refinance doesn't work out, you've got your house, you're secured, no big deal, right? Their job, they'll literally shake a phone line for 30 investors and get you the best pricing in the market. For purchases, they're not always the best for the reason being that there's good wholesale banks and bad wholesale banks. And to be frank with you, their job is to packet the paperwork in hopes that it meets the investor's guidelines. They have no control of the underwriter. Most of the time, they can't talk directly to them. They're just, again, sending them a file paperwork, hoping it pans out. So I would say for purchases, not that I'm being biased because I am a true banker, your best bet is to work with a direct lender because everything's under one roof. If I need to pick up the phone and call a favor from a manager, they're going to follow through with it. Versus a broker, hey, as an investor, I've got 3,000 of you. If I lose one or, I just didn't pick up the phone, maybe I had a bad financial month as an investor. Sorry, Charlie, this is what the terms are, right? So that's the difference in broker. As a banker, I have my own processing staff. We fund our loans with our own money, And then what ends up happening is once that loan is funded, there's two types of banks. This is when we get to the bigger aggregators. What I just expressed to you was what's called a correspondent lender. I am approved to sell loans with other investors. I have FHA branding and permission to create these loans. Now, this is a secret sauce to it, guys, is the direct lenders, because there's less middlemen, less margin involved, we have a little bit of better pricing generally. It's not in every example. Some companies might be publicly traded or have higher cost of operation, but 8 times out of 10, this is, the concept that is true. So with that being said, when I use my own money, I don't have to pay a third-party broker or all these additional vendors that we can cut off from that margin. In addition to that, if I am approved to service loans, that means you're going to make your payments to me. There's not a single bank that will promise you that they will service your loan through and through. In fact, you sign a disclosure in most cases saying that, hey, this loan can be sold to another investor. So the bigger guys like Wells Fargo, you're typically going to land with them. US Bank, you land with them. It's usually the smaller banks that need the liquidity because, hey, we all use credit cards, they're warehouse lines to fund and operate. And at the end, we need to free up our credit so we can go write more loans, right? So when you hear somebody saying I'm locking a rate, we're basically using capacity. Think about like an American Express card with no limit. We're using a card specifically to hold your position in the bond market. So that way, that rate that we told you is bona fide for 30 days, 60 days, whatever it is. And if we are going to service the loan, when FHA adheres the insurance and Ginnie Mae pays us to refresh our warehouse line, we would basically agree to collect the payments on behalf of FHA Ginnie Mae. If it ends up being that we are not going to service it, like I sold it to a bigger guy like Wells or maybe PennyMac, some of these larger servicers, Mr. Cooper's another big one for FHA. Those folks basically pay the bank the margin that they agreed to for that loan, that particular rate, and those are the folks that are going to collect your payments. Now, you brought up a good, valid point. So that's the secondary market. To get even deeper into weeds, what ends up happening is think about 100 loans in a folder. Okay, that's a mortgage-backed security. So people are saying, hey, the value of that might be, $3 million a month in interest that you can expect to collect. And that's hoping that people don't refinance quicker than later, right? Well, sometimes people do refinance if the rates go down. And now the position of that investor is, hey, we were expecting to, over 5 years, maybe make something to the degree of 120 million, and we didn't. Instead, now we're only going to make, 90 million. But our exposure and position, we only, gassed 80 million. So we still made a $10 million profit. Believe it or not, in America, we are credit and debt driven. Unfortunately, when you hear about GDP, global debt positions, we have more debt in the US than we do have assets. And that's just kind of how the markets have shifted. But you're absolutely correct. The investors that do buy these huge pools of debt are usually people that are like the Vanguards, the BlackRocks, the 401k administrators. And again, what they're banking on, guys, is that people will make their payments. And that's why the underwriting guidelines, they all measure risk assessment. They're looking for good pools of debt for people that will make their payments on time. And that's why the better the credit score, the better the interest rate, right? So it kind of all goes full circle, but we all unfortunately cater to the investors that buy these loans. So if they make a decision and say, hey, with COVID, we no longer have an appetite for 620 FICO, guess what? All the banks are going to say, well, we're not going to write loans we can't sell. So now we don't have an appetite for 620 FICO. So it really is a direct correlation between Wall Street and investors down to, the local mom and pop shop brokers, because at the end of the day, we all need to release our warehouse lines to go out and write more loans. So we got to bend over backwards for these guys.
And what he means by releasing those funds is the bank can only lend with whatever they can back, right?
Whatever assets we have, right?
So if you keep lending money, that's why they sell your loan. So whenever you buy a house and you get a loan, that loan is going to be sold because they need to have liquidity so they can continue lending. And then, so let's go back to FHA. So what is the current guidelines for FHA? What's the minimum credit score? You were mentioning that, it goes down to 580, but most lenders don't do it, right?
Yeah, so we're lending down to 580. You typically need to have 2 years of stable job history. It's okay if you had a break in employment. I'll give you an example. Very commonly, software engineers, they might do a 6-month project here, 8 months here, take a month off, and then do, same cycle again. That's completely okay. What will hurt you is if you have more than 6 months of a gap of employment. Okay. Now, there's very few exclusionary rules to this. I'll give you an example. If you had a spouse that was dying from cancer or a parent deceased, and you can prove, hey, I had a job for 13 years, this is what happened, or I got laid off after, the pandemic after being there 13 years, the bank will have discretion to say, is this guy still good debt or bad debt? And the last 13 years show that he was stable, so we're going to work with you, right? So that's underwriter discretion. But yeah, so what they're after is credit, 580 plus. The collateral, meaning that it's a good home, it passes appraisal. In all honesty, FHA is a little bit more stringent on appraisals. Why? It's a government agency, Federal Housing Administration. things like, you know, roofs that might have less than 3 years of shelf life, the appraiser may note it and it may need to have some preliminary repairs. Things like bars on windows they're not cool with because if there's a fire and it's a safety hazard, right? Another one that we commonly see in Arizona is sometimes somebody's like, hey, don't really see the financial benefit of fixing this pool. I'm just going to sell my house. For that reason, the pool's a little green, the filter needs some work. FHA would say, hey, this could turn into a mold or a mosquito pit. You got to get this fixed. Even things like you don't have a fence or safety feature on the pool, you got to get that fixed. So consult with your loan officer. I usually take a look at the property. If something looks off, I let the listing agent know. We work as a team to cure that before the appraiser gets out there. But yeah, guys, it's the credit, the collateral, and then the cash to close. Generally speaking, it looks good if you're using your own funds for closing. The higher the credit score, the least concerned the underwriters are. The lower the score, sometimes they add additional rules saying, hey, you had a bad FICO score. We want you to be financially stable. You can't use a gift. So every bank's a little different. You got to really make sure you iron that out with your loan officer on the consultation.
Okay.
Yeah.
So the credit score can be 580. I mean, and then from there up.
Yep.
2
years of stable employment.
Yeah. The other thing that most people don't know or understand is that you don't need a 20% down. Right?
That's right. We're talking 3.5% down if the lenders you work with are approved to do down payment assistance. It means that the state has endorsed them to give out some sort of a bond program. The one that we commonly use, there's two types. There's a forgivable and a non-forgivable. So what that means, guys, is basically if you bought a house and the down payment was 3.5% down and the state agreed to give you 3%, there's what's called a second loan on the property. Now, the way this one is set up is you live there for 3 years, you make your payments on time, that money's forgiven. I kid you not. It's literally free money. And the thought process is we want to spark housing in Arizona. We want to help the underserved. And you guys, the bigger the population, the better that Arizona profits from taxes. The economy does better in Arizona. So the thought process is there. We're seeing cities built, literally in 6 month stretch. And it's good. The state's making money. So, but back to that position, you do want to get an unforgivable one. I do work with some folks in California, and those are set up where it's non-forgivable. And they don't realize where they go to refi after 2 years and they're like, hey, my balance went up 18 grand. What the heck is going on? Yep. Well, hey, you bought a $600,000 house. They gave you 3%. And that 18 grand, they didn't say it was free. It was a loan. So
it's a silent second with the
That's right. That's right. And
so it's a second loan that you have on the property. They gave you that possibility to get into the home, yet they're going to get paid when you sell that property.
If you sell or you refi, that's right. But the one that we use is AZIDA Home Plus. That's the one that allows you to have the forgivable seconds. And the caveats to that, you can't be too rich. FHA is under 112,000 in income, something to that degree.
That's pretty generous, though. Right?
It is, yeah, especially for a 2-person family. And then you have to have above a 640 FICO. The state makes their own rules in terms of what they deem to be qualified individuals. And again, you got to live in there for 3 years, so it's not too stringent. The program's pretty available to most people. I would say either way, if you want to have a good underwriting experience or a good interest rate, your goal should be to get to above a 620 FICO either way for that reason. But just know, guys, buying a house, first-time home buyers, it's very accessible to you. This money is not solely allocated to first-time home buyers. You actually have the ability to use that money every 6 years.
Awesome.
Yeah.
One more thing. So we had a question, and I was recently in Mexico with a possible investor. Okay. And they have assets, quite a bit. From what I got, it was close to $1 million, right? Okay. They were asking me about a loan, and they actually told them, I don't know if you know this answer or not, but what they were asking is, are they able to use collateral, that money as collateral, to get a loan here?
Well, the answer to that is yes and no. If somebody has a lower FICO score, but they have enough cash and assets to buy the house.
Well, this was an investor from Mexico. They're not even a U.S. citizen.
Yeah. Well, I'll play devil's advocate on both. If somebody has a beat up credit score, but they have tons of cash, the bank will see that as what's called a compensating factor. So FHA, they do the riskier loans because of the mortgage insurance that's bonded with those loans. So as an example, if you're 1 year out of bankruptcy, you can actually get a FHA loan. It's tougher. The compensating factor in that example might be you've been at your job for 13 years, you owned a small restaurant and the pandemic wiped you out. it was a one-time occurrence, but you still have 250 grand in the bank. The bank might say, hey, this guy had a side project that, kind of ruined him on the bankruptcy. He did well in his housing performance. He had another job that he kept, and he also has tons of money. We're going to give him that loan, right? He seems like a debt. So that's the consumer aspect. On an investor level, unfortunately, FHA, they only lend to primary housing. So because it's a government agency, they only want to help the regular mom and pops, the regular families. In fact, they're so reserved in their decisions that, as an example, they don't even lend in luxury houses.
Right.
So how do you make that determination? Well, FHA every year takes a look at the median average sales price as well as the median average income. Okay. So in Arizona, right now, it's works out to a purchase price of $455,000. It's a loan amount of like $438,000 versus conventional loans. Those are rallying as high as, a little over $625,000. Okay. So it does make a big difference. Depending on what your financial profile looks like, hey, am I going after this purchase price of a house or am I dealing with this? Okay. And to even go deeper is sometimes you might be married and you have commonly one spouse who's a stay-at-home individual, or maybe they had a bad event and the other person in the family said, hey, I'll carry us through the finances, but that car payment, let's just let it roll over on you. So because Arizona is a community property state, there's a total of 7 guys, not just Arizona. In our state, the good, the bad, the assets, the ugly, lawsuits, it's all shared. So as an example, if you had a mister who had a bankruptcy and he's got, 30,000 in collections, even though the wife may have an 800 FICO score and she's trying to buy, we still got to pull the credit of the husband. And it's the saddest thing because it does happen probably once a week in my camp. You have one person who did very well, took care of the family, handled their finances accordingly. But on the opposite side of the spouse, they went through some tough predicament, and now we don't qualify because that person has so much bad debt that other person has to carry when they qualify their debt to income schedule, that FHA doesn't make sense. So then from there, we go to the drawing board and say, hey, can we qualify you conventional? Because it's a privatized loan system. They don't follow the state laws of community property law, right? Okay. So there's good and bad on everything. It's just, again, goes down to that consultation of having somebody who's experienced and knows the guidelines very well.
Good. And I think the question is, like I said, this guy, the person I went and met in Mexico, they have beautiful businesses down there. They do amazing, and they own a home here in Texas, a huge mansion from what I've heard. And they have plenty of money in Mexico, and they have assets here. Yeah. They're foreigners. They're not even. So this is going to be aside from the FHA.
Sure.
Do you know of any products like that?
There is. There's twofold. There's the ITIN lending if they're not U.S. citizens. So they would need to set up some sort of a vehicle. All loans, you have to pay taxes on the property, right? So the way that the guidelines are set up is either a corporation is paying the taxes or an individual, but you need that ITIN number in order to do that. These investors, they're considered what's called non-QM, non-qualified mortgage. So they're not banked on regular bond markets. They don't have to conform to Fannie Mae, Freddie Mac, or Ginnie Mae. So with that being said, they kind of make their own rules. If they have an appetite for it, they'll lend on you. Typically what I see is that they want 25% down. Sometimes they give you a break if you do have existing US credit, but for the most part, these individuals that are foreigners, they don't. So it's the ITINs. Believe it or not, some of these programs require that you don't have any investments in the US and that it is an investment property. Why? The guidelines are set up different. Even though you don't have a traditional mortgage, the CFPB says, hey, if it's your primary home, meaning the only house you have in the US, we'll protect you with these guidelines, meaning you can't just be thrown out after one bad payment. You got to go through some sort of a modification attempt or foreclosure attempt process, right? Versus an investment home, hey, you miss one payment, they could technically take it from you, right? Yep. So the guidelines are written different. So that's on the ITIN side. On the foreign national side, very similar concepts. There's a difference between a full document loan and either credit qualifying or asset qualifying. Typically with foreigners, they just want to see your bank statement activity. What assets do you have in the US? So for the client you mentioned, that would probably be a better product because it's asset qualifying. If they see their bank statements have, as an example, $20,000 a month in positive cash flow, that's 240 grand a year. The bank's probably comfortable giving them a $3,000 mortgage, right? Because we looked at the last 2 years of bank statement activity and you were good for it.
Right.
So that's a situation there. But again, they have to have the stomach for the 20 to 25% down.
Got it. Okay. Awesome. I think that's, do Do you guys have any questions out there? Do you, Legna, have any questions?
Yeah, I was wondering, out of all the loans, do you think the FHA loan is the most common one?
It's changed a lot. I think conventionals become popular too. No?
It is, and I would say it kind of depends from market to market too. So in Arizona, there's kind of a stigmatism, especially in Tucson. They don't like FHA loans at all. They just don't do it. Okay. It's not to say that you can't get in the door that way, but you're probably going to have to put a much bigger earnest money deposit or make some sort of a commitment to them to make them feel better about using that type of money. And why? Just some listing agents have this mindset that FHA money comes with somebody who's got a beat up credit score. In California, I can tell you that FHA is widely accepted. And it might be because people in California are sometimes house rich and cash poor. So a lot of people do have debts. And with FHA loans, you have a higher debt to income ratio. So it just, again, it really depends on that. But with me personally, I would say I do write a little bit more FHA loans than conventional loans. But that has started to change in the last 6 months.
Yeah, it seems like people are doing great. And obviously you have better terms with it. Going with actually with a conventional loan than with an FHA because you have like permanent.
Yeah, that's the one thing we should talk about is FHA has PMI for life. That's the private mortgage insurance. So it's a calculation. If you do 3.5% down, it's 0.085 of your loan amount. If you do over 3.5% down, it's 0.08. So I'll give you an example. If it's a $300,000 purchase, 0.08 ends up being $2,400 a year. Your payment would be $200 higher with FHA because of the PMI. If you did a conventional loan and you do more than 5% down, depending on your FICO score, that quote might be as little as 0.23%. Right?
Wow, that's a big difference.
It is. So instead of you paying an extra $200 a month, say an example, you might pay an extra $50 a month, right? So it's a little bit more than that, but ballpark it with me. So, and if you do 20% down, you wouldn't even have PMI.
Right.
So if you have the cash and liquidity, I would say it's definitely wise to do the 20% down. I don't know about you guys, but it doesn't sit well with me when I know I'm having to pay heavy taxes or having to pay burdensome insurance that I don't use or benefit from. We all need it for the purpose and vehicle of what it serves, but that insurance does not go to principal interest. It's not tax deductible. So if you can avoid, paying money to a big, fat, rich insurance company, that's your best practice.
Basically having a TV and everything going on in one room, lights and everything for the whole month and not even using it, right? It's just money that is getting burnt every single month.
Correct. But the offset is they'll do the lower FICO loans down to 580.
Definitely. So if you guys have any questions, if you guys are considering purchasing or refinancing, obviously call an expert. Don't ask your friend that, just refi because there's a lot. Not every loan is the same, right? And not every situation is the
Property
same.
by property, profile, financial profile by financial profile.
People make different amounts of money. People have different types of credit scores. They have different capacity. They have different equity.
Yeah.
So the best thing to do is to just always talk to a professional. And we get this quite often, because our market is active. So people are constantly buying and selling homes.
Right.
And just because they sold one or two, they feel like they're experts. Honestly, there's a lot of bad advice that I hear out there. That's why we started doing these videos. We want to be your resource. We don't want to just be someone that's going to be here just taking your business without providing you any value. Our goal is to inform you, to provide you with the right tools. So when the time comes, you make an educated decision.
Yeah.
And it's not just based out of what somebody told you that they think that was the case, right? There's many ways, like I said, that these situations can go. And for that reason, the best thing to do is always go to the expert. I joke about this. If you feel sick, do you go to a priest?
No, you definitely go to a doctor and you let them do the checkup.
Exactly. If you're going to go to court, do you take a doctor?
Absolutely not.
Right. And take a good lawyer too. Get a good realtor, get a good loan officer. You don't want to go with cheap. Cheap ain't good and good ain't cheap.
Well, I would say you want an advisor because there's probably a time where you have a question on something that comes in the mail. I get people all the time and say, hey, can I write off the closing costs? I mean, Juan goes above and beyond. After somebody does a purchase with them, he sends them the final settlement statement. And there's a lot of things you can write off on there, guys. So It just goes to testament that he's a real advisor. He does care about his clients. The most common question we get is somebody's like, hey, I bought this house 5 years ago. I got a very low payment. I see I can make 200 grand. What do you think, Juan? And the guy could say, hey, I'll sell your house and help you buy a new one and double dip. But the right thing to do is say, hey, your mortgage is $1,100. I just ran the rental comps. It looks like I can get you a tenant close to $1,900.
Yep.
If we can do a refinance, keep your payments at $1,500, give you $100 grand to buy a new house and fits your exact wants and needs. That's something that we're doing real time, day after day.
Very, very common right now.
And people are like, "Oh my God, I'm debt free.
Yeah.
My housing payment went up $200, but I don't have to pay the extra $900 a month in car payments, credit cards, and not only that, I got in my dream house, and this person is paying my mortgage while the equity grows. I'm making $400 a month, and my payments are pretty much the same. This is a sweet setup."
Yep. And I have 2 homes now.
Exactly.
And somebody else is paying for it.
With
right?
the tax write-off benefit.
Exactly.
So there's a lot of stuff out there, guys, that again, we're not just here for the quick bucks. We're here for advisors. I can tell you 9 times out of 10, if you give good advice, people will refer you, especially on a very personal and intimate conversation like this. And that's what we're after, is the referral network.
Yep.
Definitely.
And that's how we live. Most of our clients are past clients, referrals, and past
Agreed.
clients. So, and do you guys have anything else?
Yeah, there's something I would love to talk to you guys about. So every marketplace is unique. I'll give you an example. Maybe countryside of Missouri off the Mississippi River may not be as hot with real estate as what we're experiencing here in Phoenix, Maricopa County area. And a lot of people are saying, "Hey guys, I'm seeing the rates are going up a little bit, so I'm a little nervous on that. I'm seeing that people are bidding each other for houses. I'm a little bit nervous about that." And I get it. These are realities of life that we are having to face.
Experience.
The question that you have to ask yourself is, does this make sense? And is there a break-even period for me? Whether you do a refinance, there's a break-even period. So I'll give you an example. If you have to roll in $5,000 into your loan, but you're saving, let's just say $500 a month. Well, in 12 months, that's $6,000. So it makes sense to do the refinance if you're going to live in the house for 1 year,
Yep.
right? It's the same with the purchase. If you're going to buy a house and you had a bid with 5 other people and you agreed to pay $5,000 above the asking price or $5,000 above the appraised value, obviously that's a kick to the shin. We're paying more than what we wanted. But the question to ask yourself is, was this a wise investment? And I can tell you, at least in Maricopa County, I'll let you speak on this percentage, but I think we're seeing appreciation around 17% year after year.
28%.
28%.
last year.
Okay.
So
I was
if you-
reserved.
Yep.
Right.
If you own a home that was $500,000, you're about $150,000 more. It was crazy.
Right.
It was a lot.
So
So-
would you spend $5,000 today, knowing if you sold the house in 2 years, you profited 100 to 150 grand?
Yep.
To me, I think every person would say that's a wise investment, right?
Not only that, you're going to be paying rent for those whatever years, right? And
Yeah.
every single month you pay, that rent's going to go in the garbage.
Yeah.
So by you investing in a home, and again, we don't know what the market's going to do. We don't have a crystal ball. Yet what we know is that year over year, natural average appreciation is 3 to 5%. So no matter what, you're always going to be investing in your home, and that value is going to grow. But what we're seeing is, and what they're projecting for this year is 20% appreciation.
That's right. I know this sounds really scary, guys. I ran the numbers. My data comes from Mortgage Brokers Association. So when we do those loan applications, it does get fed to a database for Fannie Mae and Freddie Mac and MBA to digest for real-time stats. For every one individual in the U.S., there's 0.0002% of houses.
Yep.
So I want to make that clear. For every one person,
I can make
there's
it-
a fraction of a fraction of a fraction of a house.
Yep.
So what we're experiencing is that there's still a lot of people coming to the U.S. from other countries. Our population size is not
We're
stagnant,
beyond that.
and there's not building enough houses quick enough.
Let
So-
me give you a number that is going to kind of blow you guys' mind. You know how many homes we're short for the whole country?
I don't know.
4 million homes.
Okay.
So what you're seeing right now
Scarcity.
is not that people are buying houses because the neighbor bought a house and made money. They're buying a house out of necessity, and we didn't build. I live this market, and I've been talking about it for a while. From 2008, 2014, we barely built some homes.
Yeah.
2014, we kind of started building, and now we're going crazy, but we don't have materials. So it's not that the market is going to crash because people are speculating on homes. People are buying homes because they need a home.
Right.
Right. So what you guys are seeing is not just speculation. It's people buying a home because they need it, and the problem is we don't have enough.
It's an influx of supply and demand.
Yep.
And anytime there's a shortage, people hike up their pricing because, hey, we can.
Yeah.
And you want something that we got, there's 300 people behind you that are willing to pay the price.
Yep.
So again, what I'm trying to paint the picture is yes, this market, depending on where you are, will call for possibly paying a little bit higher than what you had anticipated. But the question to ask yourself is, will I recoup those funds? Was it worth that investment? And what the metrics are showing us is that we are experiencing a housing shortage nationwide. And there's an old saying, right? You follow the money.
Yeah.
And the biggest investors out there, BlackRock, Vanguard, I mean, Google it, please. Don't just take what we say.
They have billions of dollars.
Yeah, even Zillow was buying houses 10, 15% above market price without even looking at it. Why? Because they know, hey, the dollar's it's depreciating, right? It's losing its value, but real estate always goes up. We know there's a shortage, so they're hedging their bets. Yep. They know, hey, rather than me keeping money in bonds or gold or whatever it is, I'm going to move it to real estate, knowing that there's a shortage. So instead of making maybe a 5% hedge here, I'm going to make 25% year after year,
yep.
right? So again, guys, the old saying is follow the money. If these people are doing it and they have analysts and they have guidance like Warren Buffett, major people like that.
Yep.
I think there's some truth to that. Definitely.
100%.
Yeah.
And just think about it this way, guys. If you, and I had a client just recently call me and says, I was actually arguing with my bank because I have $200,000 in there and they gave me $10. And I said, well, you know what? The bank is making money on your money.
That's right.
They're lending it on credit cards, which is, guys know what the credit card interest is?
It's average of 24%.
Okay. So they're making 24% of your money. So out of those 100,000 or 200,000 in 1 year, they made $50,000. Am I right? Right. Around there. So, and I told them, why don't you take that money and buy a house, right? And have a tenant make payments. You're still going to have a little bit of leverage because the bank's going to give you a portion.
Yeah.
And then you buy another house with the other 100,000. And now there's 2 payments that you're receiving. Now you're making the interest. You're saving on your taxes, the insurance, depreciation. So if you want to make money with your money, don't put it in the bank, please.
Yeah. What's the average savings return? I think it's AYP of like 0.34 if you're lucky.
It's a joke.
Yeah.
Really?
And they're over there making money hand over fist with your money.
Exactly. So if you have money in the bank, I don't know how you would feel about this after you hear this, but if you put it in real estate, I mean, that's where it goes.
It's the number one vehicle that's made the middle class rich is buying low, selling high with real estate. And you don't have to be an investor, guys. It might just be something that, hey, I've got a good eye for decorating and I found a house that needed a little bit of love. I was okay living in it in 2 years and fixing it up. Sure, maybe that's your style. If you want to go hard and you want to buy multiple houses, at that point, you definitely want to consult with a professional.
Definitely.
Yeah.
Awesome, guys. Well, I hope you guys got something out of this. Thank you so much.
You covered a lot.
I think that wraps it up.
Yeah. Awesome.
Well, thank you for the opportunity. Have a great day.
Take care.